morning, everyone. Welcome to this presentation this morning. I'm Mick O'Brien. I'm the Managing Director of EQT Holdings Limited. Now, firstly, I just want to have Equity Trustees acknowledge the Aboriginal and Torres Strait Islander people as the first Australians and respect their long and enduring connection to the land on which everyone is today, wherever they are. We pay our respects to all their elders, past, present, and emerging. In today's presentation, we intend to share with you our analysis and the findings that we've extracted from an analysis of Equity Trustees' last 100 managed investment schemes that we've developed and launched over the last several years. I'm sure will provide you a fascinating insight to the trends shaping the funds management market currently. It's very much a contemporary picture because fund establishments are really a lead indicator of the direction of the industry. So today you're going to hear also from Russell Beasley, our Executive General Manager of Corporate Trustee Services, and also from Johnny Francis in Sydney, our General Manager of Business Development and Custody within Corporate Trustee Services. So the agenda for today is to provide you with an overview of all of our findings, share with you a considerable amount of data from Equity Trustees' business. We'll take questions at the end using the chat function. And finally, you might ask what all the fruit is about. Well, you probably don't know that Australia's most popular fruit is the banana. Apparently, we average 20 kilograms of bananas each year, but our tastes are changing. And if this question was asked 10 years ago, the answer would have been apples. Now, the state of the funds management industry is also constantly going through change and evolution. And in fact, from our experience at Equity Trustees, we have never seen so much change in funds management away from the mainstream major asset classes towards an incredibly diverse range of micro, more specialised and complex micro asset classes. What you'll see as Johnny goes through the analysis and our findings is a really significant change in the industry. We're seeing a greater variety of strategies than what we've ever seen. Direct real estate funds from different countries, different real estate sectors not seen in Australia, digital currencies, ESG-orientated strategies, sustainability-focused strategies, religiously impacted or social impact strategies, litigation funding schemes, precious metals in different designs, hedge strategies, and incredible diversity of fixed income strategies that we've seen really evolve over recent years, utilising an increasingly diverse range of fund structures. So anyway, before we get into it, let me first hand over to Russell Beasley, who's going to quickly describe to you Corporate Trustee Services business, and that gives us the base for this analysis. So over to you, Russ.
Thank you, Mick, and good morning, everyone. The Equity Trustees Corporate Trustee Services business was established in 2000 after the introduction of the Managed Investments Act. Since then, we've grown to be the largest independent responsible entity and trustee of managed investment schemes in Australia. We currently have over 130 international and domestic investment management firm clients, and we oversee in excess of 350 managed investment schemes with funds under management and supervision of around $100 billion. We also have offices in London and Dublin, which provide similar independent trustee services in the UK and European markets. Now I'll hand over to Johnny to commence the presentation.
Great. Thank you, Russ and Mick. And look, before I start, I might just say this has been a very interesting exercise looking at the last 100 appointments. We have some really interesting clients, funds and trends emerging. And it's really fascinating to see how the market is evolving to cater for the needs of the industry. So I hope you'll find this insightful. So looking first now at which type of fund is the most popular. This is the typical spread of different fund types here, but registered funds clearly are dominating the market with 70% of funds being established as registered managed investment schemes. That's closely followed by the unregistered managed investment schemes, the exchange traded funds and the listed funds. There's been an enormous interest in listed vehicles, particularly around the dual registry funds and the ETFs, and we'll talk a little bit more about that later on. We've also seen the emergence of the corporate authorised representative service, given some of the licensing challenges in Australia, and again, I'll touch on that later. Turning to the wholesale or the retail division, there's a clear theme here that retail products are far more popular given that they provide additional distribution options available to fund managers. We can see that there's a much greater percentage of retail funds being established, both by volume and by number. And funds on platforms such as Hub and NetWealth and other platforms, and listed funds as well, both on the ASX and the CBOE, really do continue to be attractive as an avenue for retail money. So we can see now that really out of the last 100 vehicles that we've established, only 1 in 5 of those funds are purely wholesale in nature. Turning now for a focus on listing a fund and some of the considerations to think about. The original markets of listed products were really the listed investment company, and the advantages of those products were franking credits, dividend smoothing, and potentially less compliance. However, pricing departures from NAB did present a significant challenge to managers, and there have been some underperforming LICs in the market. Some managers have looked to convert those products to active ETFs or unlisted managed investment schemes, but some still do remain with a significant discount. When considering a conversion of an LIC to an ETMF, there are some tax considerations to think about, particularly where there's in-specie transfers, and there's also significant costs in doing so. But having said that, converting one of those vehicles can be very attractive to cure that discount. EQT has facilitated several of these conversions over the years, so if there are any managers looking to potentially convert, we can certainly support that. 2019-2020 saw a surge of the listed investment trust. The advantage of these trusts were really that they were a vehicle for tax purposes. They were a flow-through vehicle for investors, and they were very attractive for managers because they provided locked-up capital for them to trade. However, NAV price departures did remain, particularly in credit and fixed income products, and we saw that at the beginning of COVID, although a lot of those have recovered. Government rules on the stamping fees were also changed, making it much harder to launch an LIT in the market. Brokerage was effectively banned and the LIT market stalled. So where are we today? Well, all new vehicles are basically active ETFs that we're seeing. The advantages are that they are still the pass-through vehicle from a tax perspective, and they also now have a much closer NAV, which is in line with the trading price, given that there's a market maker and an INAV provider in the structure for liquidity purposes. Having said that, the products can be more expensive and they do tend to have a higher MER. Since 2001, fund registry providers have now built capability for dual registry funds with a listed and an unlisted sleeve. So the listed sleeve is effectively an active ETF, and unit holders are fungible between the two. So they're very attractive. Listed vehicles are obviously designed to attract flows from the direct investor market, and in particular the self-managed super fund market, where immediate and continuous liquidity is highly valued. Turning now to the types of strategies that we're seeing. Now, clearly a fund strategy will obviously depend on the purpose and the objectives of the particular fund, but a large proportion of our managers are now holding direct investments, with a lot of appetite still for feeder fund structures. And this is really being driven by the foreign investment managers looking to access the local domestic market. Reasons for running a direct strategy may be that they simply want to replicate an offshore strategy that they're already running, or they can potentially be less complex than running a master feeder, particularly where there's different administrators or custodians across the master and the feeder structure. So often it is very beneficial to have the same service providers across the two structures. Feeder funds, on the other hand, they do have the benefit of potentially leveraging the track record of the offshore master, which can be very attractive. And there's obviously an initial large pool of capital in that offshore feeder, which is attractive as well. Feeder funds in Australia, they can reduce transaction costs, which can be quite attractive, particularly for emerging market strategies or frequently traded funds, where the custody and transaction costs can get quite expensive if you're running a direct strategy in Australia. So the feeder can be more suitable. When looking at the feeder or direct strategy, it's important to think about some of the CFC tax issues and the consequences there, particularly where the Australian feeder fund is holding a significant proportion of the master fund. Looking now into the the number of classes that we're seeing. So historically, it was very common for our fund managers really to have a single class in their fund. But really, we're seeing a much greater proportion now of funds are looking to have multi-class or multi-unit class funds. And this really is in an attempt to achieve greater market coverage in a more cost-efficient manner. So we can see now that in the last couple of years, 23% of all of our funds have included multi-unit class structures. So the attribution managed investment trusts, or the AIMIT rules that were introduced, they were really designed to make the multi-unit classes much clearer from an equitable and a taxation perspective. The main reasons for these really around differential of fees. So managers can have bespoke fee rates for wholesale or retail clients, whether that's institutional or family office money. They can negotiate different rates, which is giving them more flexibility. Managers now have the ability to have hedged and unhedged strategies of the same fund, but in different unit classes, which is very attractive. There's no restriction on the particular strategy that can go into the fund, and there's no exclusions. And managers can even offer multi-diversified asset class strategies with completely different risk profiles, although it's not that common. So the multi-unit classes have really been very attractive, and we're definitely seeing a trend towards that. And really, it's just to achieve greater market coverage in a more cost-efficient manner. We've even seen some managers setting up completely different asset classes in a single MIS, almost as if they're looking at launching an MIS platform, although we haven't had an enormous amount of interest in that to date. Looking now at which of our clients are setting up hedge funds and some of the emerging themes that are coming through. So when we talk about hedge funds, what we're really saying here is whether or not they pass 2 of the 5 tests for RG240. So those tests are whether or not they have a performance fee, they're using derivatives, shorting, leverage, and the complexity of the product. So what we're seeing now is that almost a quarter of our funds are being categorized as hedge funds, and therefore do require a long form PDS. A noticeable proportion of funds are using derivatives in various forms, and really that's in an attempt to achieve better returns and access asset classes which otherwise just would not be available to them. So there's clearly a trend there. In terms of the themes for the funds themselves, although more than 80% really don't have a primary theme, so to speak, we are seeing new themes emerging, and they really do impact what's available in the market. ESG has evolved enormously. We're now seeing sustainable development goals and ultra ethical code of governance funds, which are Sharia compliant for Islamic investors. We've also seen the emergence of carbon neutral funds, and that's becoming more and more popular. And we expect to see this trend continue as we move towards a carbon neutral world by 2050. Focusing in on the ESG side of things, global awareness of socio-economic issues has really seen the emergence of these funds, and they're now actively discriminating on this basis, focusing on climate change, ethical and sustainable considerations. We're seeing an enormous variety of different ESG strategies, but really the key focus is the impact on the environment. The range of strategies is extremely wide, from those that simply have small exclusions to those at the other end of the spectrum, where they're actively looking to invest in a positive manner by adopting a much narrower investment universe. And then there's everything in between. An increasing number of our fund managers are also signatories now to the UNPRI directory and are fully committed to incorporating ESG into their investment strategy. So clearly we can see that to attract the flows, really ESG has to be front and center when thinking about product manufacture. Many Australian super funds have also now signed up to be tobacco free, which has caused managers to follow suit. And given the Russian sanctions, a number of our clients have had to exit those positions where they do have exposure to Russian stocks. To reflect EQT's continuing commitment to this area, we have appointed a general manager of responsible investing who sits across the firm. Turning now to the different types of asset classes we look after. So again, this is just for the last 100 funds. This isn't all of our vehicles, but this is just a snapshot of where we are in the last 100 vehicles. So you can see here that we support the full spectrum of asset classes. I don't think there's not much we don't have exposure to these days. You can see there's a very typical spread here of asset classes and some very common themes. Global equity and domestic equity were very popular last year, with more than 50% of funds being set up with those particular asset classes. And that was closely followed by fixed income and multi-asset vehicles. There's been a lot more appetite emerging for alternative strategies, particularly venture capital and renewables. And we've also seen, as Mick said earlier, we've seen the emergence of litigation funding schemes and interest in currency funds and commodities as well. So you can see that our clients really are investing into pretty much all the asset classes available, all the way through from property to fixed income, equities and alternatives. And we expect that trend to continue. A slide here really just focusing on some of the more interesting and unique funds that we've launched. So starting at the top left, we launched a quant strategy. And this is a master feeder fund, which ultimately invests into China A shares, looking to outperform the MSCI China index. It's got more than 400 China A shares with turnover of 150%. Some of the challenges here really are probably around the disclosure of the performance, which has been quite stellar, but also an education piece just on the market. So it'll be very interesting to see how that particular product is taken up in Australia. We recently launched a US student accommodation REIT on the ASX. That property is indirect, so it's not holding, that fund is indirect, it's not holding the assets directly, but ultimately investors are getting access to a portfolio of properties in the United States. And that's available, as I said, on the exchange, so through the retail brokers. One of the challenges there is something I mentioned earlier, which is the potential discount to the NAV. So we'll see how that performs. Another very interesting fund that we're working on currently is a physical gold and a carbon credit exchange traded fund. This fund in particular aims to provide investors with exposure that tracks gold and carbon emissions. So there's a heavy ESG focus and also that carbon neutral theme also coming through. Again, it's available to retail market through the ETF listing. I think one of the particular challenges for this fund was really around the custody of the gold. Holding gold bullion in vaults is something that we've not seen before, but also calculating the emission profile of the gold supply chain. And I think we even had to have a license variation on this particular product. So been very interesting to work on this one. And then finally, I'm sure everyone on this session is very familiar with this asset class because that's what everyone's talking about, digital assets. We do now have a fund which has exposure to digital assets. It's not a direct strategy. I don't think I've seen any direct holdings in the retail space, but this particular fund uses derivatives or futures to be precise, giving investors exposure to digital currency. Again, challenges, this is a new asset class, but it will be very interesting to see how this particular asset class performs given the recent ETFs that were launched in Australia. Turning now to the fund flows year on year. Now this is by investor type, and this is just a quick look at where the flows were going in April 21 versus April this year in 2022. We can see that there's a clear preference here for retail products, and that includes listed funds as well. The majority of flows are really going to the retail vehicles, whether that's directly or indirectly through platforms. In COVID, we saw the emergence of millennials and younger investors into the market, and some of those were for the first time. For them, ease of access through smartphones, ETFs, micro-investing apps, really that's paramount to that group of investors. So products such as dual registry funds, listed funds, they will really continue to see the flows, particularly from younger audiences. You know, I think that the days of filling in paper application forms for those particular investors are probably long gone. Wholesale funds have seen some uplift during the last 12 months, but really the retail flows are probably a reflection of the global economic conditions and investors seeking regulatory comfort. So clearly there's a clear trend here that if you're looking to raise capital, you really should be looking at the retail market. Fund flows year on year by asset class. So again, this is the same period from April last year to April this year. There's been much greater flows into global equity over the year, and also domestic fixed income in the last 12 months as asset prices grew with COVID support and quantitative easing around the world. We've seen increased flows into alternatives, particularly venture capital, private equity, and multi-asset funds as well. We've also seen, as I mentioned earlier, the emergence of new asset classes, including digital assets, and also more interest coming through in commodities and currencies. I think these trends probably reflect the switch from traditional banking products such as term deposits, given the low interest rate environment that we've been living in. It'll be interesting to see how this chart looks next year with interest rates rising and where asset prices are. So we'll see how that goes in the next 12 months. Turning now to the fund flow year on year by fund type. So again, the clear theme here is that retail and listed products, they continue to dominate the market and attract all the flows. Increased regulation and investor protection is really driving that theme. And a large number of our clients now are looking to convert their existing funds into dual registry funds just to provide greater distribution options. And we're working on a number of those at the moment. One thing that stands out for me here is whether or not the listed investment trusts, if there'll be any resurgence in that particular product, or whether all the flows will go into active ETFs in the future. And one other thing on this slide is perhaps potentially next year we'll see some flows into the CCIV regime, but we'll see how that goes. Having a quick look at some of the licensing options and challenges for our managers. So we can see here that in the last 100 vehicles, even though the split between domestic and global managers was quite even, the majority of fund managers do have an AFSL, or they are using the class order relief regime. The main benefits really to having a domestic footprint in Australia is really around that product distribution, showing that they're committed to the market, they can meet investors, and they can really demonstrate that they're here for the long term. AFSLs can take 9, even 12 months to receive, so more managers are relying on the corporate authorised representative arrangements or looking at class order relief from their local jurisdiction if it's available. The corporate authorised rep arrangement service really just allows managers to get their products away quickly. They can market and distribute the product, and they can run the fund until their license comes through. And look, we expect this trend to continue, given that there's some changes coming through to the class order relief regime and also the foreign financial services. Looking now at I mentioned the feeder master structure earlier. This is a snapshot of where those master funds are located. So you can see here that EQT supports investment managers globally with funds all around the world. Our clients really are using typical tax-friendly structures and locations, with the Luxembourg CCAB clearly being the most popular, followed by Cayman vehicles. We can support managers who are holding offshore vehicles with any type, so whether that's shares or units in an SPV, and quite often EQT is also providing custody for those particular arrangements. Whether or not the corporate collective investment vehicles take off in Australia might impact that, as managers really look to potentially replicate their more familiar corporate structures down in Australia. Looking now at where our managers are located. So as I mentioned earlier, 55% of managers are Australian based, but still a lot of offshore managers, 45% are based overseas. You can see here that we support managers in all major investment hubs globally, and we're represented in almost every continent around the world. Global managers have become more active in recent times after 2 years without travel. It was obviously very difficult for new managers to come to market, but we've recently seen clients from the UK, Singapore, and the US have come over to visit, and we're definitely seeing a lot more interest from new managers coming to market in Australia. So I think the trend there was that existing managers who already had products out here or a footprint, they were looking to do new products in Australia, but the brand new managers really held off until COVID sort of died down a little bit. As the borders open up, we're definitely seeing more interest from managers, particularly Asian managers, and there's been an enormous amount of interest out of Hong Kong. In terms of our footprint, this isn't where all of our offices are, but this just shows our footprint in terms of our clients. EQT has Australian, London and Dublin offices, so we're very well placed to support clients from all over the world, and we do have an extensive footprint. So what are the key trends and takeaways? Well, look, this was the first of the series. We will have more comparative data each time we roll these out. So hopefully, the data will grow and become more meaningful. As our industry grows year on year, superannuation grows year on year, there's always more demand for local products. We've seen enormous growth both in FUM and the number of funds in our business. As Russell mentioned earlier, we have more than 100 billion. I think it's close to 110 billion now. We have more than 300 retail schemes and more than 400 vehicles where we're acting as trustee or responsible entity. Obviously, COVID did impact the environment in the last couple of years, but as I mentioned, we really think global managers will come back to Australia. We think there'll be an enormous boom in the next year or two. Socioeconomic awareness is really driving these ESG themes, and we certainly expect that to continue. We're seeing managers trying to get cost efficiencies by using the multi-class fund and the AIMIT regime, and that may also expand into the CCIVs. We're seeing an enormous diversity of investment strategies. Managers have to diversify and differentiate their products if they're looking to stand out. And clearly, fund managers are looking at listed vehicles and the retail space because clearly that's where the flows are going. So we're seeing an enormous amount of interest in listed vehicles, particularly the ETFs. CCIVs, there hasn't been an enormous amount of interest to date, but they do launch quite soon. But really, I think the interesting piece will be where do the flows go now, given the impact of the interest rate environment. Okay.
Fabulous. Well, thank you, Johnny, for that. I think that was really insightful as to what Equity Trustees has seen in the last 100 schemes that we've developed and put to the market. So we're now open to take questions from anyone, and you can put them through on the chat line or on the Q&A. So I'll start with the first question here, which is, do you think we'll see any LICs being converted into a CCIV? So there's a few acronyms there. So I might hand that one over to you, Johnny. So are we going to see listed investment companies being converted into corporate collective investment vehicles?
I would say the short answer is no. And I think the reason for that is if you ask any lawyers or tax agents, they will tell you that they haven't really solved for the conversion. So there will be tax implications of converting that structure. Sorry, you can hear me, mate?
Yeah, no, I can.
Sorry. Yeah, so I think the short answer is no, because I think there's some tax issues to iron out when looking at converting those schemes. So from what I've heard or what I understand, I don't think it will be as straightforward. I think they'll trigger some implications for tax.
Sure. Yeah, no, got it. Thank you. I think obviously tax is an impediment in basically winding up a LIC before converting to another structure. So okay, that's good. All right. Well, the next question I've got here is, are there any themes on fees? Are we still seeing fees trending down, or is this flattened out? So maybe Russ, I might put that one to you.
Yeah, look, it's a good question, Alex. We have seen fees being fee pressure or margin squeeze being driven by a number of factors. One is the internalisation of investment management functions by the super funds and the larger scale that they're operating with. So we are still seeing fee pressure. I think we're probably at a you can only squeeze the lemon so hard, but I think we're now at a point where it will start to flatten out. But it's a good question.
Thanks, Russ. Two more questions, but the first one's a simple one. Will this presentation be sent around to attendees? And we can certainly do that. So if we can get a copy of it. The next question is, how many active exchange traded funds do we have in the pipeline? So I might put that one to you, Johnny.
Several. I can't name the particular clients, but a lot of those are really clients with existing unlisted funds, and they're really just looking to access the dual registry approach. So we're seeing more interest in converting existing vehicles as opposed to brand new to market ETFs, but we do have several that will be coming to market soon, and quite a wide range of asset classes and strategies, which is interesting.
Great, thanks, Johnny. John, I think the next one might be a good one for you as well. So recent new LIC transactions, such as the one that PIMCO pulled out of, show it's possible to pay stamping fees provided the client is satisfied as wholesale. Yet such eligibility is easy, and it looks like a loophole to enable payment of incentives to sell an issue. What's the future of the payment of stamping fees, if you've got any observations on that?
Yes, correct. There are ways around it. We've seen a couple of cap raises on some existing LITs in the market, so it can be done. It was interesting that you mentioned the PIMCO LIT. I think they were looking to raise 500 million, but they were concerned around potentially a pricing discount to the NAV, which I understand, or they felt like they couldn't raise the money. Yeah, look, I'm not sure where that'll go. I thought we might see some more LITs coming back to market, but really I think with the emergence of the active ETF, I really think that seems to solve for some of those challenges that the LICs and the LITs have had. So that would be my money would be on the ETFs.
Got it. Rightio. Thanks, Johnny. Another quick question. Is there interest in AUD hedge classes of unhedged global funds? So maybe I'll put that to you, Russ.
We did see a flurry a while ago. There are several that we set up. It seems to have died down a bit, but I don't know, Johnny, have you seen any more recent trends?
No, I haven't. Particularly Ross, I haven't seen that trend, no.
Mm-hmm. Thanks, Ross. Thanks, Johnny. Now the next question is, as additional strategies and structures are taken on, how is EQT keeping up with all the newest risks that come along with these? Maybe I might take that. Well, you know, Equity Trustees is a specialist trustee company in all the lines of trusteeship in which we operate, and there's quite a lot of synergy between what we do for managed investment schemes and fund managers, as well as what we do in the superannuation space as a trustee, and also as a trustee of private client arrangements. So across the board, we feel we have the skills to be a trustee of all these types of structures. But, you know, when it comes to very complex investment arrangements, there's a couple of key principles that are absolutely critical to us, and they are about ensuring that we understand what it is as to how the investment strategy is operating. So that means we need people who've got investment capability across a broad range of strategies. We understand the ownership and custody of the assets. That's absolutely critical. We understand the liquidity of those strategies so that we know what we're disclosing to investors is a match of the liquidity of the investments. And obviously the quality of counterparties and the like is essential. So the reality is we need teams of people who have got capability in operations, capability in investment strategies, capability basically in the operations of investments, so structuring schemes. That requires quite a bit of legal background as well. So we've got all those resources. I think the team under Russ has about 40 people or so. And you know, I'd say there's really no structure we couldn't put into place. I'll go into another one here. If you are a capacity constrained manager, i.e. the strategy can only support a maximum level of fund to generate its alpha, how can you launch an active exchange traded fund if you can't soft close an active ETF? Have you got experience in solving for this challenge? That's an excellent question.
It is an excellent question.
Very good question. I might, well, who wants to handle that, Russ?
Well, we haven't got to that stage yet,
No.
Nick, but it'll be an interesting one. But you can have a crack at it if you like.
Well, now look at that. That is an interesting question. So far, most of the exchange traded funds that have been put into market are strategies that you would not expect to be that capacity constrained because of the liquidity and also the alpha generating aspects of the strategy. But it is a good question. I think you've got our to put our thinking caps on to think through that one. So, but we're not there at this stage on really any of the strategies we've got in the market, so we'll take that one on board. So, yeah. Let me move on to the next one. How do you define retail funds, and how do you separate that from platform funds? I noticed you had both on the same chart along with wholesale insto. Perhaps I'll hand that one to you, Johnny.
Yeah, so what we really, whether it's direct retail or indirect retail, so what we were trying to say was if it's got indirect access through a platform with a PDF, we were classifying that as effectively retail and platform money, whereas wholesale was purely with the IM. So what we were saying is whether it captures direct retail money or indirect retail money.
Right, thanks, Johnny. Another one here is there a common denominator with LICs trading below NAV, example size, or it's simply performance? Do you want to take that one, Johnny?
Yeah, there's an easy way to find that. You can go straight onto the ASX website and download a spreadsheet which basically shows the whole discount. I think for managers really to make them successful, they've got to be out there marketing them, promoting them. I think if you look at some of them, potentially they've fallen by the wayside because maybe they're not as prominent in the market or as well known. And I think some of those managers have sort of struggled a little bit. So I wouldn't say there's one particular factor. It probably just comes back to marketing of the product ultimately, and making sure that investors are still keen on that particular product.
Thanks, Johnny. I think that's an excellent answer. I think it's quite nuanced, as Johnny was just pointing out, and there's no one single factor. And sometimes, discounts can emerge and then be very, very sticky for long periods of time that it's unexplainable, but it is what it is. So the next one is, with a very recent change in government in Australia, what impact do you think this will have on the investment market, strategies, etc.? Or perhaps I'll take that one. Look, firstly, a lot of what happens in the funds management market comes from what happens in the superannuation industry of Australia, because it is the dominant pool of capital, basically. And the incoming government really hasn't announced major policy changes in respect of superannuation. You can bet, though, that they'll obviously be very supportive of the current configurations within the superannuation market. So I don't see really any change in that respect. Then it comes down to, I guess, whether there's going to be material economic change that might drive different investment market factors. That's hard to say. I mean, obviously, I don't think it's government related per se, but it's more where we are in a cycle at the moment of, shifting to a rising interest rate environment, emerging themes of material inflation and what might happen, in the wages market as a result. So all those things will have an impact, but I don't think they're particularly, government related. The next question is, are you seeing alternative strategies which may have long shorts or derivatives that participate in the ETF aqua market? Traditionally, they are not allowed to do so, as they do not always have transparent pricing. So Russell, Johnny, who would like to take that one?
I think we've introduced a fund recently that does allow shorting. So the answer is yes, we have seen it. It's one out of quite a number that we've got. So we haven't seen a real run on these at the moment.
Thanks, Ross. Next one is, how often are you having to run these discussions, and are you considering broadening the panel to include any of our supply chain, any of your supply chain, sorry? I think we'd be playing, we've had a good number of participants come on board today, so that's great. So I think we plan to do this every year, given the volume of data and what we actually see coming through the market. And I think the idea of including some people in our supply chain who are critical to us being able to structure vehicles, that the support that they give and the services they provide, I think that would be an interesting extension of what we're doing. So next question is there a significant interest for setting up carbon credit funds? And do you expect that to increase in the near future, especially with the change in government? So I know, Johnny, you, I think, been working one particular fund in that area. I might hand over to you on that one.
Sorry, what was the question, Mick? I didn't quite...
Is there significant interest in setting up carbon credit funds?
Oh, yes. Yes, there is. There seems to be a lot of interest in having a carbon credit or a carbon neutral theme or thematic to these products. So the one I talked about specifically has incorporated that. Really, it's the ESG theme that's coming through, and we're seeing more and more of these of interest in these particular funds, and we expect that to continue. They can be a little bit challenging. They're not as some of the market pricing for these carbon credits can be challenging, but they certainly can be done. So the short answer is yes.
Right. All right. Thanks, Johnny. I'll whip through a couple of others. Are you seeing advisors seeking lower fee classes for inclusion in SMAs? So, Johnny, I might put that one to you as well.
Again, yes, but to Russell's point earlier, at some point you reach the bottom and you can't squeeze the lemon anymore. There has been a squeeze on fees over the years as managers really try to differentiate their product, and certainly products with higher MERs do attract more attention and potentially don't get the flow. So we are seeing that, but I think, as Russ mentioned, there comes a point where you can't really go any further.
Thanks, Johnny. Next question is, do you expect the 45-55% split between domestic and international managers to continue, or will the percentages change in the future? So, Russell, I might hand that to you.
Yeah, that's a good one. Look, we continue to see interest from offshore managers. Although we have quite a number at the moment, I think there are still more that will come into the market. We have seen a reduction in the number of domestic managers by virtue of the internalisation of some of the super funds. So my expectation is we'll see that 45% increase going forward.
Thank you. Next one is, do you do due diligence on the fund managers, especially if they are new or unknown? So I might hand that one to you, Russ.
We certainly do a significant amount of due diligence on all our service providers, particularly the fund managers. We have an extensive questionnaire. We do site visits, ongoing due diligence on them, because clearly at the end of the day, as the responsible entity or trustee, we can outsource the function, but we can't outsource the overall responsibility. So it's a critical area for us.
Fabulous. Thanks, Russ. We've got a couple more questions. Do you have any views on the availability of an Australian UCIT structure from July 2022 to meet Australian investors' needs? So I think this is referring to the corporate collective investment vehicle structure that comes in from July 2022. So, Johnny, I might hand that one to you as to what you see the demand for that to be.
Sure. So to date, the market for that has been quite minimal. I think there's still a few tax considerations to iron out, and they're not particularly advantageous when comparable to a trust. I have a feeling that it might take maybe a very large offshore group to come down and roll out that particular product and add it to their suites before we see more interest. I think at this stage, it's just not attractive enough for anyone to be the first mover in that particular product.
Fabulous. Thanks, Johnny. And two quick last questions. Will this recording be made available? The answer to that is yes. Sorry, three quick last questions. The next question is, are you seeing more interest from ASIC in the wholesale fund space? Historically, wholesale funds were off the radar, but ASIC seem to be keener to understand the wholesale market better. Can you share any insights you have? Yeah, look, perhaps I'll take that one. Look, we are seeing ASIC being more active across the wholesale space. I think there has been some debate, in the market in recent times that the definition of wholesale has become dated and is probably a little low compared to when it was first established. And I think that's probably a fair assessment. But broadly, we are seeing much greater activity from ASIC full stop across all investment schemes and fund managers. And I think, some of the diversity we've talked about here is worrying them. and then wanting to understand some more detail about that. We are, constantly responding to their requests for information in this area. Two more quick questions, and then we'll wrap up. Are you seeing any wholesale fund of funds with performance fees, knowing that the underlying funds have performance fees? So, Russ, I might hand that to you.
Yeah, look, I typically, if the fund has a performance fee at the underlying fund level, we don't see performance fees charged at the Australian feeder level. It's a simple answer to that.
Yeah, thank you, Russ. And the last question: how much are you involved in the valuation of assets? What happens during disrupted markets, such as for illiquid bonds, where spreads are wide and prices uncertain, Russ?
We certainly had a situation, like that with market dislocation quite some time ago, where spreads widened and we were getting requests to amend spreads intraday. So we get, obviously, when it's, we have these difficult times, we have a product governance committee who meet on an ad hoc basis to make determinations in terms of valuation. So we do get involved. Typically, it's only in those distressed times or market dislocations that we would become involved. Otherwise, the prices are readily available. But when there are difficulties, we certainly get involved.
Thank you, Russ. All right, well, that brings us to the end of the questions. We've run 2 or 3 minutes over the time that we allotted, but I want to thank, firstly, Russ and Johnny for sharing with us those insights. Thank all the participants coming online this morning. I hope the insights from that analysis are useful. We're operating in a very dynamic and changing funds management market at the moment here in Australia, and I think that'll continue. So, the more knowledge we can share, we're more than happy to do that. So thank you, everyone, for coming on board this morning.